Well, this morning, the Bank of Canada, as was widely expected, cut its benchmark interest rate for the first time in 4 years now, took it from 5% down to 4.75%. That's nice. A lot of people were expecting that. But what does it actually mean for investors? And probably more importantly, what does it mean for Canadians in general? I'm going to look at 5 key takeaways from this morning's announcement. And I want to start with the fact that the rate cut might seem like just a minor adjustment. It's 25 basis points, a quarter of a percent. Doesn't seem like much. But importantly here, it could be the start of a series of cuts. And you think back over the last couple of years, we've been through quite a stretch of rate hikes that were put in place to manage inflation. And so this shift towards the easing could be taken with a breath of fresh air. It kind of gives us a little bit of hope. It also suggests that borrowing could get cheaper over time. So that would make it easier for people and importantly businesses to manage loans, potentially stimulating economic growth. So that's the first point, is that this could just be the start of it could be a launching point for more lower rates to come. It is important for point number 2 here to note that there will be minimal immediate impact. So this cut by itself, it's not going to, materially lower mortgage payments for the most part. It's not going to make car loans significantly more or inexpensive, lines of credit, that type of thing. It is a small step, but it's setting that stage for further interest rate cuts down the line. Point number 3 is that this is setting an example that Canada is now the first G7 country to start lowering rates. So the bank is essentially leading the pack in making this a policy shift. It could influence other major economies around the world. Tomorrow, the European Central Bank will be announcing its decision, so we're going to see what happens there. And if things do go well for Canada, a number of other countries might follow suit, especially if they're facing similar economic conditions that we are here at home. Fourth point, the implications for real estate and for the economy in general. And an obvious benefit of lower interest rates is that it gives this sluggish real estate market a much needed boost. And although prices have been high, the sector itself has been underperforming its long-term average for the past couple of years. Again, I don't see an immediate impact on this, an immediate effect, but lower interest rates will make mortgages a little bit more affordable. That might just encourage a few more people to get into the markets. But it is a double-edged sword here, because we don't want to see this overly strong demand taking housing prices up too much further from their current levels. On a broader scale, this could also help kickstart not just the real estate sector, but also boost overall economic activity through things like increased consumer spending, investment. As I was mentioning, the Canadian GDP has struggled. We've seen minimal growth. We've seen increased business insolvencies. We're seeing rising unemployment. And although we don't want to see inflationary pressures coming back too strongly, obviously we do want to have a support system in place for a strong Canadian economy. That goes without saying. And fifth here, Governor Macklem made it clear that the bank is in fact prepared to make further rate cuts, but he emphasized that the bank will be taking a cautious approach. He said they're going to be taking this one meeting at a time. As potential risks, he noted, he talked about geopolitical turmoil and the possibility of a sharp rebound in home prices here in Canada. The bank doesn't want to undo the progress that it's made in tackling inflation by moving too quickly here, and he emphasized that it's a balancing act. You want to stimulate economic growth without letting inflation slip out of control again. So expect future decisions to be data-driven. It's only a 25 basis point change, but it is a pivotal moment here in Canada's economic landscape. I do want to go into a little bit more detail on what today's rate cuts might mean for mortgage holders in particular, because that's such a big effect on our lives, our economy here. First off, at least initially, like I mentioned, the rate cuts aren't going to bring massive changes. They're going to bring only minimal savings for borrowers. This morning, I was looking at an analysis by the Globe and Mail, and it shows that most people are going to save less than $100 or so after this 25 basis point cut. The analysts looked at different scenarios involving floating rate mortgages, home equity lines of credit, and other credit lines, and it showed a modest impact of this quarter percentage point rate reduction. Rebecca Oakes, she's vice president of advanced analytics at Equifax Canada, and she said it's a little bit of help, but it's not going to have that much of a material effect in terms of their ability to make payments, or if you're hoping to buy your first home, get a foot on that ladder. So this suggests that while these rate cuts might offer some relief, it's not going to significantly change most borrowers' financial situations. But for those of you who have floating rates, like adjustable rate mortgages, you will see an immediate benefit on those. An example given in the Globe and Mail report, it shows that homeowners with a 5-year adjustable mortgage rate at 5.95% and a $328,000 mortgage balance would see their monthly payment drop by $47 after this rate cut. Similarly, a first-time buyer purchasing a home at the average price of $703,000 and change with a variable rate mortgage would save $96 if the rate dropped from 5.95% to 5.7%. And then homeowners with HELOCs, home equity line of credit, you would see slight reductions as well. For instance, a borrower with an average balance of $101,000 and change at 7.7% would see their minimum monthly payment decrease by $21. And those with personal lines of credit or auto loans would experience an even smaller savings. For example, someone with $11,790 on a personal line at 8.2% would save just $2.46 a month. James Laird, who is the co-chief executive of RateHub.ca, he noted that the effect on fixed rate mortgages are going to depend more on the central bank's overall messaging. And he says the words are what's going to matter. If the Bank of Canada seems hesitant about future rate cuts, then fixed mortgages could stay the same or even rise. He noted, on the other hand, if the bank signals more aggressive rate reduction, then fixed rates on your mortgages might fall. At this point, though, today's rate cut is going to provide only marginal relief to most borrowers. In a couple of weeks, on June the 19th to be exact, I'm going to be tuning in to hear what Jeremy Siegel has to say. He's the Wharton Professor of Finance. He's an acclaimed author, and he will be talking about the current economic landscape that's influencing the stock market. And he will be joined by Michael Kovacs, who is the president and CEO at Harvest ETFs. And anytime you have the chance to gain a deeper understanding of investment strategies, it should be welcomed, in my opinion. Professor Siegel, on this session, he will be discussing the impact of global economic shifts on stock performance. He'll be forecasting movements in interest rates and inflation and outline strategic investment approaches as we move toward the 2024 elections. During the session, you're going to hear how some experts are navigating the stock market in this volatile economic climate that we see ourselves in today. You can join the session for free, but please reserve your spot now as space is limited. I will put a description in this video. Also, we are gearing up to hit the road again, and this year we're going to be in 4 Canadian cities, and for the first time ever, we're going to be making a foray down into the U.S. to welcome our new U.S. Blossom subscribers with a New York City stop on the agenda as well. Last summer, we met over 1,000 Blossom members and Investing Academy students, and we are looking forward to meeting more of you this year. For those of you who couldn't make it out last year, I will encourage you to sign up for one of the events. Also, please note that we did sell out last summer because some of the venues that we're attending do have limitations. I would expect the same thing will happen this year. We are going to be in Toronto on June the 25th, New York June 30th, then Montreal on July 2nd. Little bit of a breather, then we'll be back in Calgary on July the 15th. And Vancouver on July the 18th. And this year, we're going to be joined by 15 or maybe even 20 or so different creators that you're probably familiar with. For example, Adrian, who's better known as Canadian in a T-shirt, he'll be joining us. Also, Shay, the humble trader, will be on the tour with us. I'm sure you're familiar with Daniel Pronk and his YouTube channel. Instagram and TikTok phenom Joy Yang will be along as well, and many others depending on the location that we are going to. So if you are a DIY investor, I would highly encourage you to come out, hang out with us. I will put a link for all of the venues in the description of this video. U.S. private payroll numbers, according to ADP, fell short of expectations in May. The companies added 152,000 jobs, and that's lower from the revised 188,000 jobs in April, and it came in well below the Dow Jones estimate of 175,000 jobs. This is now the lowest monthly job growth since January, and it is an indication that the U.S. labor market may be showing signs of slowing. Annual pay growth did remain steady at 5% for the 3rd consecutive month. Now, ADP's chief economist, Nala Richardson, she commented on the situation, saying job gains and pay growth are slowing going into the second half of the year. She also noted that while the labor market does remain solid, there are notable weaknesses in both producer and consumer sectors. The bulk of the job growth in this report came from the services sector, adding 149,000 jobs, with goods producers contributing just 3,000. Specific sectors like trade, transportation, and utilities led the gains with 55,000 jobs, and that was followed by education and health services with 46,000, construction with 32,000. Now, in the loss column, we saw manufacturing jobs lose 20,000 jobs, while natural resources and mining, information, and professional and business services also saw declines. Small businesses, particularly with those with 20 to 49 employees, lost 36,000 jobs on the month. And now this ADP report, it comes before what is a more critical non-farms payroll report that is coming out this Friday. It's expected to show a gain of 185,000 jobs in May. So there's recent indicators. They're suggesting that we are seeing this hiring slowdown with jobs dropping to just over 8 million in April. And that's now the slowest since February of 2021. And that adds to growing concerns about the overall health of the U.S. labor market. TC Energy shareholders, they've given the green light to spin off the company's liquid pipeline business into a new firm that's going to be called Bow Corp. And this move will create two separate publicly listed companies. So TC, of course, based in Calgary, is going to continue to manage natural gas pipelines, storage, and power businesses. Bow will take over the liquids infrastructure, which includes a 4,900 kilometer pipeline network. The idea for this spinoff here, it dates back to November of 2020, and initially the company was considering selling its liquid pipeline business, but it found that a spinoff would offer better value for its shareholders. President and CEO Francois Poirier, he described this decision as a monumental moment for the company. But despite this, the market reaction is fairly subdued. TC Energy prices were just slightly up after this vote. For those of you who are TRP shareholders, you're probably going to welcome this move as part of a broader strategy to manage the company's debt more effectively. On that front, the company recently sold a 40% stake in its Columbia Gas Transmission systems for $5.2 billion to Global Infrastructure Partners. And this sale is part of a plan to offload non-core assets and minority interests to fund expansion without taking on more debt. Now, that said, some analysts are skeptical about how much this reorganization will actually help reduce TC Energy's debt, at least in the near term. Now, the spinoff of Bow Corp is expected to be completed by the end of this year. With this change, both TC Energy and Bow will now have independent access to capital markets, which means they can operate with separate balance sheets. And this should give each company more financial stability and a clearer focus on each of their respective businesses. So no doubt this is a big shift, and the long-term effects of this decision are still uncertain. Couple of things just before I finish off. First of all, I will put those links for our upcoming tours in the description below. I hope to meet a lot of you there. If you are not subscribed to our Pulse newsletter, I will make that easy for you. I will put a link in the description of this video. I am here most Mondays and Wednesdays with this report. As always, thanks so much for watching. I will see you in the next video.